Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we're coming off of very slight but still positive gains for the S&P 500 on a weekly basis.
True, but September not so good for stocks or bonds.
It's going to get scary. Let's get to the biggest stories right now in the more than $17 trillion global ETF industry. And we kick off a busy week for Wall Street with inflation data a few days away and stocks rising to a record on bets that the Fed is ready to cut. In just a moment, we speak with Alyson Shupe. She is head of global product strategy over at Goldman Sachs Asset Management.
Plus, we'll focus on dividends. Lionshares launching its debut ETF, which doesn't pay dividends to keep things tax efficient. Lionshares CEO and founder Sofia Massie will be here.
On the other hand, though, you have Gen Z chasing high dividends. We'll discuss why young investors believe that that is the answer to addressing their financial headaches. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. Yeah, so while the young investors chase dividends, the boomers are still buying a lot of beta, right? Look, this is Vanguard, VU, $5 billion. That's big even for VU. VU is now, I think, $83 billion on the year, probably a lock to break its $100 billion record set last year. And all ETFs at $802 billion. They're on pace for $1.2 trillion, which would break last year's record. Still time on the clock, though. We'll see. IVV also, I'd call this leaning retail. And then we got cash and gold, right? So you've got a lot of U.S. stocks and a lot of gold and cash. That's been the trade all year. I want my equities, but I want a little protection, too. But this is largely retail. Let's look at the outflows. And what's interesting here is two of these trading crowd favorites, SPY and the Qs, with big outflows here, especially SPY. That's $15 billion. Throw in IWM. These are used more by traders because these are the more liquid ones that they're used to. So I want to look at the difference between the trading crowd and the buy and hold crowd, because sometimes they are not on the same page. And here's a chart that we've made in BI that we look at the ETFs that are used by the buy and holders versus the traders. And they've been moving in lockstep most of the year. As you would imagine, traders are a little more volatile coming in and out. But look at this. That would be a massive outflow for traders versus the inflow for retail. That is about a $22 billion spread. That's about as wide as you see. Now, it's only a week. There could be noise, Katie, but I don't know if this could portend a little bit of selling coming up.
Yeah, we'll have to see, of course. As Scarlett mentioned, September, typically a pretty hairy time for global markets. We'll keep an eye on that. But let's keep this conversation going now with Alyson Shupe. She is head of global product strategy over at Goldman Sachs Asset Management. Great to have you with us, Alyson. So somehow it's September. We are staring down the barrel to year end. And the big takeaway of this year, similar to last year, is that active is very hot, but it's a certain type of active. It's this derivatives enhanced income strategy that seems to be taking the market by storm. And that's a trend, of course, that Goldman is participating in.
Absolutely. Yeah, derivative income as a category overall is the leading space where investors are allocating their assets this year. And it's really been a build from prior years as well. So even this year is not exactly a new phenomenon for many of us that have had derivative income strategies in the market for quite some time. But we really are continuing to see this demand for additional sources of consistent high monthly income. Derivative income ETFs are delivering exactly that.
So JEPI is the leader in the space, and it feels like they're the name that people go to. I'm wondering how sticky that money is. Do investors tend to go in and out of these kinds of funds, or once they find the one that they like, they stick with it, and it's all about expanding the market?
Sure. So I think that on the whole, investors should be sticking with these strategies for the longer term. I think for newer entrants to the market, we obviously launched our two derivative income ETFs a few years ago, and there's been many, many more coming to market. It just gives investors more choice. And so they may have had fewer options in the past in prior years with certain derivative income strategies. Now they have a lot more to think about. They have other new types of outcomes that other ETF managers like Goldman Sachs are delivering to them relative to maybe what they had previously. So they may be looking to make a switch.
So we look at the percent of ETFs that use derivatives, and that, I think it hit about 35%, 40% last year. It's come down a little, but, you know, a good chunk of them use derivatives now, especially on the active side. Do active managers need to do a little something extra, like a little more legwork than just stock picking? Hence the JEPI, where, okay, we're going to pick stocks, but then we're going to do some options work on top. Is this the future of active?
It's definitely part of the future of active. I would say part of the real growth that we've seen in options-based derivative income strategies is also due to the fact that there has been a little bit of a dearth in income from traditional asset classes, such as long-only equities. You can't get as much from dividend-paying stocks as you might have in previous years. And so option strategies are just a great way for active managers to think differently about delivering a different outcome for clients. But I would say that might be part of it, but it's also going to be about finding other avenues beyond just derivatives to add value to client portfolios.
I want to talk about taxes here because we had a fantastic piece last week about Gen Z chasing these dividend-paying ETFs, these high distribution rate ETFs, which we'll be speaking about a little bit later with Vildana Heinrich. But one of the things is that you think about the tax implications of some of these funds, some of these options overlays, and they can get pretty scary. And I just wonder, from where you sit as the head of global product strategy, how you start to approach that.
It's a really, really interesting challenge to solve for because the trade-off of getting higher income is there is a tax trade-off there. Mm-hmm. Obviously, they're phenomenal for IRAs, those that are not prone to taxes, that can withstand don't have the tax treatment associated with higher income strategies. But that's why I think also derivative income strategies are a great solution because many of them don't actually have the same type of tax implications as traditional long-only income-oriented strategies. Mm.
As ETFs take over everything, and of course we're ETF IQ, so we're a little biased when we say things like that. Is there anything that doesn't work in an ETF wrapper?
Ooh. Certain things we have to be really, really thoughtful about. And that's really what we're thinking about at Goldman Sachs is there's a lot of stuff being thrown out into the market, a lot being thrown out.
Like
lots
privates?
Of choice. For example, privates, for example. We have to be really, really well connected with the ETF ecosystem to ensure that there is proper liquidity, proper risk management, and that we're really thinking about all possible scenarios when putting relatively newer instruments in an ETF. Those are conversations that we're having on a daily basis. Not to say that not everything can go in an ETF, but I think you have to ask yourself a different set of questions. Mm.
So all this hype on active, but I'm old enough to remember smart beta. Remember that?
Me too.
Yeah, I mean, it still exists. And you guys really put a stake in the ground 10 years ago with GSLC. Multi-factor. It's active, but it just uses rules.
Absolutely.
It's got 14 billion. What's going on with this? Are you finding that people are just as interested in smart beta these days, or are they now want actually more than something like this? But the key was at 9 basis points. I mean, so you got Goldman's brand name for Vanguard fees, and it's got 14 billion, but is active over trumping this?
I would say on the whole, the growth in active non-strategic beta ETFs is starting to eclipse the organic growth in strategic beta ETFs on the whole. When I think about strategic beta, for example, GSLC, but many others that incepted about a decade ago, that was really before many active managers were comfortable or able to offer ETFs in a truly active capacity. There's certainly, as you mentioned, $14 billion worth of investors that really have stuck with the smart beta strategy. You can offer it at a lower price point. The returns are very consistent and people know what they're getting out of a smart beta strategy relative to maybe something like active that might have more discretion and maybe has higher fees on a relative basis. I think there's room for all three. We're seeing our own multi-asset solutions team thinking about complementing traditional market cap weighted with smart beta with active in areas like model portfolios.
So we've seen the ETF industry absolutely balloon in terms of assets, in terms of the number of funds, and in terms of the number of issuers. And given where you sit, you have this really unique perch on the industry. I wonder if you think that we could see some consolidation here. We've seen M&A pick up across different industries and different sectors, but we haven't really seen it come necessarily to the ETF industry, maybe a little bit in asset management, but not yet in ETFs. And I wonder how you see that evolving.
It's definitely on the horizon. Obviously, when you think about the decades upon decades of the mutual fund industry before you really started to see big consolidation in the last 10, 15 years, I would say the ETF industry is likely to move in that trajectory as well across the entire ecosystem from the buy side to the sell side. That's certainly about to happen.
Well, I mean, I think we need a bear market, no, because you could see all these outflows from your mutual fund, but if stocks keep going up, you have more assets simply because your holdings went up. I think a bear flat market for a couple of years things could get crazy. Like we could have all these companies joining together. Thoughts?
You're looking for a bargain, it sounds like.
There's certainly all sorts of different opportunities that I think the industry is considering, and what are the different trade-offs. I think for M&A in general, for anyone, the bar is incredibly high, and we're really excited about what we're building organically. We are really, really focused on that and building thoughtful solutions that can navigate bear markets, that can navigate bull markets, to the extent that there are opportunities that arise from a specific market shift across the asset management industry. I think everyone's looking at what those potential options are.
Well, as we keep mentioning, September, things get pretty hairy. Maybe some places will go on sale. Alyson, great to get some time with you. Really appreciate you stopping by. That is Alyson Shupe of Goldman Sachs Asset Management. Now, coming up, as we were just talking about, dividends over day jobs. We'll discuss why Gen Z investors are chasing 90% yields in order to quit those day jobs. What a drag. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with gold. We were talking about big demand for gold last week, and you can see it's continuing. We have GLD up on the screen here. This is State Street's physically gold-backed ETF, and you can see assets have been absolutely soaring, especially just in the last few weeks, now approaching $120 billion. We will continue to follow this, but let's talk a little bit about the S&P 500. We got new additions announced on Friday. There were some surprises. Strategy did not make the cut. There had been some speculation there over whether Michael Saylor's strategy would get added, but AppLovin, Robinhood, they did make the cut, added to the S&P 500. So good news for Vlad Tenev. Anyway, let's talk about Gen Z. We've been teasing this story because it is so good. Vildana Hajric, Denisa Sekova out with a big take last week, interviewing and analyzing Gen Z investors who are trying to use steady streams of cash they generate from some of these high dividend ETFs to escape the brutality of that 9-to-5 job. Scarlett, it's interesting.
The brutality of the 9-to-5 job.
Yes, coming into the office.
They don't want to be office drones. They want to
No.
make a lot of money, and they're going to put it into dividend ETFs.
God bless them.
All right, well, let's talk about this with Vildana Hajric. So Vildana, they're not exactly buying Verizon or Chevron, which have yields of 4.5% or 6%. They're looking for fancier, more exotic products, aren't they?
A lot of the money is going towards this new breed of sometimes super high yielding ETFs that give you a pretty steady stream of payouts. Sometimes it's weekly, sometimes it's monthly. There is a good cohort within this investor base that still does favor some of the traditional old-fashioned, like the Schwab dividend ETF, which is huge. It's massive, and it's been around for quite a long time. But this new breed really is growing exponentially. And my co-author, Denitsa, and I attended an event over the summer by YieldMax. It was sponsored by YieldMax. It was at the NASDAQ. And a number of the influencers that we spoke with for the story attended the event as well. And what ended up happening is they all went home and posted videos about the event and about YieldMax ETFs, and YieldMax got billions of dollars in the days after that. So it's really a very rapidly growing segment.
Yeah, I know you spent a lot of time on YouTube for this piece. So here's the natural next question. What's the catch here? What is the catch to a 90% dividend yield?
Well, to be super fair to the issuers, and there's quite a number of them that offer these products now, and the list really is growing because it's catching on with investors so much. But they will tell you that if you want to beat the market, these are not the ETFs for you. These are ETFs for people who really want just a steady stream of payouts. And the people who are buying them are oftentimes orienting their entire lives around the payouts. So they're using the payouts to pay for gas, electricity, their mortgage bills. Like really, they're structuring their lives around, a lot of times around these ETFs. So if you want to beat the market, don't buy
This is a problem.
specifically these ETFs because they will underperform.
Isn't it also a problem come April 15th when you have to file your taxes as well?
It might be, yeah, because you're going to be treated, they're not as tax efficient. It's not as tax advantaged.
It's taxed as an ordinary income. Right?
Exactly, that's right. So that might come as a surprise to some investors who were maybe interested in the here and now of the payouts and not necessarily thinking super long term. Not that a year is super long term, but even a couple months out, a lot of them really just want the cash now. And I think it's important to mention, people are seeing high inflation. A lot of people are having a hard time finding jobs. We spoke with people who are having a difficult time finding a job. And so what they want is the income. They're putting their money towards these ETFs.
Gen Z, perhaps not thinking long term.
Yeah, those youngins.
All right, Vildana Heinrich, thank you so much. Fantastic story on the Bloomberg, the new American hustle, dividends over day jobs. Please, of course, check out the story across our Bloomberg platform. Still ahead on ETF IQ, we stay on dividends as we speak to Sofia Massie of Lionshares on the firm's debut ETF, which doesn't pay them at all, for tax reasons, presumably.
There you go.
That's coming up. And also a reminder that you can listen to Eric and Joel Weber on Trillions. It is their podcast that covers the industry. They'll talk about dividends once in a while. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at a brand new ETF, a baby, TOT, Lionshares U.S. Equity Total Return ETF. This caught my eye because I saw it was actively managed, and it charges 7 basis points. That is very cheap for active, but it's a little different than that. So this is active, but what it does is it doesn't give you dividends. It's the total return of the market, but it puts the dividends back in. So it wants to compound without kicking out the dividends, which you would increase your tax drag on. So this is something, it's basically a way someone would prefer their returns. Let's look at what it holds. And again, you're going to see the market basically, so it's not that interesting here. You're going to see it holds other ETFs that essentially give you that broad market exposure, and those would obviously be the top equities in the U.S. Let's look at the performance. It's so new, so there's really no point here, but I just want to throw in XDiv, because this isn't the only ETF that does this. So here's SPY, here's TOT, and here's XDiv. These will be the ones that are probably going to be looked at together as the benchmark for this going forward. But again, this largely is something, a customer preference, Katie, for investors who just don't like to get those dividends.
Eric, thank you. Joining us to talk about this ETF, I'm pleased to say we have Sofia Massie. She is CEO and founder of Lionshares. It's great to have you with us, Sofia, because we were just talking, of course, about how Gen Z is chasing these 90% yields that you get on certain ETFs. So this is a really nice contrast. And as Eric mentioned, we're starting to see more of this strategy come into the ETF wrapper, basically trying to avoid dividends and avoid the taxes that come along with them. So talk to us a little bit about the path to launching this ETF and what logic brought you to this specific strategy.
Definitely, and thanks for having me on the show. It's exciting to see so much talk about dividends, and clearly it's a subject that investors are starting to think, very critically about. So the inspiration behind TOT is to track the broad U.S. equity market while aiming to pay no dividend. So the special thing there is that it's actively managed to minimize distributions, which is almost a crazy idea in this day and age, but it's really designed for long-term investors who want to have the most efficient exposure possible to the broad market. They're holding this ETF for years and years on end, and when you're holding, securities for that longer time horizon, the tax drag can really eat away at your returns because, as you mentioned earlier on the show, oftentimes those dividends are considered ordinary income, and they can be subject to a wide array of taxes.
So Eric was mentioning XDiv, the Round Hill S&P 500 no dividend target ETF, which launched in July. Do you see XDiv as a competitor to TOT?
They have a bit of a different approach to us. So TOT's focusing on the total market. We're really thinking about, providing the most amount of diversification as possible. So we not only track the top 500 companies, but also the entire U.S. equity market. So you're getting exposure to closer to 2,000 equities by investing in TOT. And the reason behind this is, we're trying to provide a very robust foundation for investors. This is sort of that core building block of their portfolio that they can hold for years on end very efficiently. And then they're able to add additional elements to their portfolio to get more precise exposure in specific companies as needed. But the idea behind Todd is, what's the most cost-effective, efficient way to hold that broad, diversified exposure that, it's great to have as the robust foundation for your portfolio.
And Sofia, I'm curious of the genesis of this idea. I saw what caught my eye is you're from Jane Street, who, they crush at ETF trading, made $10 billion in revenue in the second quarter alone. That's about as much as all ETFs make in a year. You were working there, and you now have this ETF issuer company. Did you find the idea there, or was it something you were thinking about for a long time? Just curious about that.
Exactly. My background is in trading. I was a quant trader at Jane Street. While I was there, I actually specialized in ETF options. So I learned all the nitty-gritty about ETFs, exactly what it takes to run them behind the scenes. I, oftentimes worked with ETF issuers. I saw the new strategies that were coming out. And while I was there, I realized there was this gap in the market for this more tax-efficient, low dividend ETF, where it felt like a lot of the products that were coming out were trying to increase the dividend, but that obviously comes with potential tax inefficiencies. So I felt like there was a need in the market for this type of product, and I felt that my skill set, especially very deep in the ETF industry from the capital market side, I had the right skill set to go out and make that happen.
And so, Sofia, we have about a minute left, but I'm curious how you market this idea, how you socialize this idea, because, we were just speaking about Gen Z investors who it seems like they just see the high yield and don't necessarily think through the tax implications. So how do you get that message out there, and who is your target audience?
Yeah, my target audience, especially at the beginning, is that long-term, cost-sensitive investor. They're building up their portfolio for, a 20-year time horizon. And I've begun to discuss the ETF with various types of investors, and oftentimes people will sort of immediately understand the appeal there. They are aware of the tax implications of their dividend, and they see that value add. There are, certain investors that don't have that full understanding of tax drag, and there is more education required there. And so, going on platforms like this and bringing that to, the attention of investors that, hey, you're receiving this large dividend, but do you really understand how much of that you're keeping at the end of the day? I think that's a really important conversation to have as these high yield ETFs become more popular.
All right, Sofia, great to get some time with you. Hope to speak again soon. That is Sofia Massie of Lionshares. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.